what Jeff's trying to do is really help you set the stage for what you need to be doing. The critical component for you as you're looking for any type of financing is, what is your revenue strategy? How are you going to make money? Too many times, I've been doing between banking and working with the SBDC, and I ran the Venture Capital Association here in town, and I've been doing this for over 20 years. And I have a number of people that have come to me that if they just had financing, they could figure out how to be successful. Well, bankers for sure, smart investors for sure, are not going to fund your education in the process of putting together a business. You need to have a strategy, whether you're working with organizations like us with the Small Business Development Center, with Tech Columbus, and obviously we work very closely together, or other entities. You need to try to get somebody to help you out, because that strategy is the critical piece that can make you be successful. So one, Jeff talked about some of the programs such as the SBIR program, Jobs Ohio, things of that nature. Well, we're starting to move down the continuum. There are public loan programs that can be helpful to your business. And we're going to spend the next half hour or so really giving you an idea of what's out there, how do you use those things. And then we're going to take a quick break, and then we're going to go into a bank panel. The bank panel is going to be a real interactive discussion about what you need to help do to get these bankers to work with you and potentially give you funding. Same deal as we go into the venture capital panel and the investor panel. What you can do to more successfully navigate that. So we're going to move forward now, and let me introduce, there he is, Jerome Jones. Jerome has, if you've been to the Capital Crash Course before, you've probably seen Jerome on multiple panels and with multiple organizations, but over the years. But Jerome is a great friend of the SBDC, has helped us with a number of different small business clients over the years. And he is going to talk about some of the public loan programs that can be of help to you. So from ECDI, Jerome Jones.
Good morning. Okay, I'm decidedly low tech here, so don't normally use PowerPoint presentations, so bear with me. As Mike said, I have been with numerous organizations. Doesn't mean I've been fired a lot. I've just been around a long time. I've worked for 3 of the 4 organizations that I'm going to present on here, and I'm on the loan committee for 2 of those organizations now. So, been around for about 26 years in banking, 16 years doing business lending, both on the public sector and the private sector. So, I have a little different perspective on business lending and the types of financing available. These programs have been around for a long time. I'm not going to say they're a secret, but you have to look for them. So I'm going to give you a path to get to some of the cheaper financing options on the public sector. The first program I'm going to talk about is the Working Capital Loan Fund. Works. City of Columbus has 2 loan funds. They have 1 loan fund geared towards just working capital. It is administered by CCDC, that's Community Capital Development Corporation. Their direct number is 614-645-6171. This program, working capital, is loosely defined as small equipment, inventory, payroll, anything that isn't a building or large machinery and equipment. Generally falls under the category of working capital. Goes up to $100,000. Now, typically, you're not going to get $100,000. Their average loan is in the neighborhood of about $25,000 to $30,000. And when I say working capital, and we'll probably go over this in the panel later on, but you cannot go to any lender and say, I need $100,000 in working capital, write my check. You have to be very specific, particularly with working capital. The other issue with working capital is it very rarely collateralizes itself. And I don't want to go too far down this road because I said we're going to go over this in the panel discussion later. If you buy a building, it's its own collateral. If you buy equipment, it's its own collateral. If you borrow for working capital, for payroll, or computer equipment, or inventory, it's not its own collateral. A bank will obviously take a lien on what's called all of your business assets, which will encompass that. But I don't want your computers. I don't want your inventory. Can't do anything with payroll as collateral. So keep that in mind when you're trying to fill that gap. And we'll go over that later. Rates on this program are between 3 and 7%. Most often it's about 5.5%, which is a great rate for a small business. Under $50,000 typically. It's a great rate. Terms are up to 5 years, but with all loan programs, the term is determined mostly by what you're financing. Computers, you do not want to finance for 5 years because it's going to be obsolete by the time you open the box. So typically that's going to be a shorter time. Inventory, short shelf life. Wages, obviously, those things are shorter terms. Some of your larger equipment, you may be able to go for a 5-year term. And you're going to have a down payment for each one of these programs that I'm going to talk about. Pretty much every loan of any type that you seek, you're going to have a down payment. And 10% is going to be the least amount of a down payment you're going to have to pay. So keep that in mind. I can't tell you how often I've met with a small business and they need $250,000 until I tell them they need 10%. And they do the calculation in their head and all of a sudden they only need $50,000. The City of Columbus also has a business development fund, also administered by CCDC. This is their fixed asset financing program. This is the program for buildings and larger machinery and equipment. So this would not include computers. This would include CNC machines, printing presses, things of that nature. Rates on this, when they say up to 7%, it's going to always be near the top end of that. So about 6.5%, 7%. And on this program, because you're financing real estate and larger equipment, terms are greater. So up to 20 years. So real estate's going to be 20 years. Machinery, between 10 and 20 years. And again, 10% down payment. Now, these rates on these two programs are outstanding. Typically, if you can get this type of financing from a conventional lender, the rates are going to be a little higher than that, typically. And these rates are also fixed. This is very important. Fixed for the life of the loan. So if you get a 10-year loan, your payment's going to be the same for 10 years. And there is no prepayment penalty. So if you have a good year, you can pay it off. And I encourage you to do so. Moving up the scale a bit. Okay. Did everyone hear me? Never been accused of being quiet before, so let's speak up a little bit. Moving up the continuum a bit, we're up to the State of Ohio 166 loan. Now the state has about a dozen loan programs. You can go to their site and see the list, but these are the ones that typically apply to most small businesses. So the other programs are geared towards larger businesses. Well, the 166 loan is what's known as a participation loan. This loan is administered through CDCs, not just CCDC, but there are other. CDC stands for Community Development Corporation. The two in town are CCDC, which I gave you earlier, and OSDC, which is Ohio Statewide Development Corporation. And you can find their information at osdc.net. And their phone number is 614-481-3214. Now, the good thing about the 166 program is a participation loan, meaning you need a conventional lender, you need a bank to do half of the loan, 50% of the loan. The rate, hold on to your hats, it's 2/3 of prime. However, prime being 3 1/4, they can't do 2/3 of 3 1/4. That's just free money. So they do have a floor. So the cheapest you're going to get is about 3.5%. They came up with the great idea of 2/3 of prime when prime was 7.5%. So they have to have a floor. Now you can get up to $500,000 on this program. In a term of 15 years. It doesn't get much cheaper than that for a building. And you can use it for machinery and equipment.
Just to clarify that?
Yes.
So if you got 500 from a bank, they would back another 500?
No, otherwise, good point, good point.
Okay, so there it's 250.
250 from the, well, you can go up to 500,000 from state money. So it makes the size of the project 125 minimum in that neighborhood. I mean 1.2 minimum. Because again, you're going to have to put down 10%. Minimum 10%. There are a couple of instances where that 10% goes up. If it's a startup business is defined as any business that's less than 2 years old or has a change of management that's less than 2 years old. So for instance, if you buy ABC Tool and Die, it's been around for 100 years, but you just bought it last year, it's a change of management. That's considered a startup. Until you have 2 years experience.
So this is designed for startups?
No, I'm just mentioning that changes the down payment. So it's not 10%, in that instance it's 15%. And if it's a single use or special purpose building, single use or special purpose, if it used to be a church, if it used to be a school, trying to think of other instances it's single use special purpose. It used to be a small bank. And the reason being, it's really hard to change a church into anything else. I know BOMA turned a church into a nightclub, but that's typically very hard to do. There's also no prepayment penalty associated with the state. So again, you can pay that off. SBA 504 program looks a lot like the state's program. It's a participation loan. Again, this program is only administered by CDCs. So those two that I mentioned. This one goes up to $5 million. So you can get a very large building because this is just the SBA's portion. which is, I didn't mention this last time, the portion of the state money and the portion of the SBA money is 40% of the project. 50% from the lender, 40% from either the state, or in this case, the SBA, 10% from you. Again, the great thing about that 40% money from both the state and the SBA is it's fixed for the term of the loan. 20 years fixed. Now, I know homeowners are used to, it's no big deal. My mortgage is fixed for 30 years. That's just unheard of in the commercial real estate world. You don't get a fixed rate on commercial real estate. Typically, the most you can get from a conventional lender is 5 years, and then it will adjust. So that 50% that the lender is doing, don't look for much more than a 5-year fixed rate. Rates being what they are, might not be a bad idea to try to fix it for as long as you can. I don't see rates going down very much. Prime being 3 1/4. Again, the SBA 504 is for real estate and large equipment. Large, typically very expensive equipment. Now, this program works a little differently. You have a fixed rate over the life of the loan. However, the way the SBA does this, they group every loan closed in a given month, and they pool them together in what's called debentures. They're just large groups of these loans, and they sell them on the secondary market to large companies like Nationwide Insurance that just wants an annuity for 20 years. So to them, it's a cash stream coming in at a locked-in rate. They pass that rate on to the borrower in the form of the same interest rate for 20 years. So makes everyone happy. Now, one of the differences between the SBA and the state is that there is a prepayment penalty associated with the SBA money. Because when they sold Nationwide that 20-year debenture, they promised them a rate of, the most recent rate's about 4 1/4 for 20 years. If you pay that off in the first half of the loan, there's a prepayment penalty. And it's a declining prepayment penalty, so paid off in the first years, it's going to be quite uncomfortable. And it's based on the interest rate. When you get toward the 9th year of a 20-year loan, it's not so bad. And after 10 years on a 20-year loan, it goes away. And I should mention there are 2 flavors only of the SBA loan. Only 10-year and 20-year. There's no 7-year term, there's no 15-year term. It's 10 years. That's typically if it's equipment. And 20 years if it's real estate.
I got a question.
Yes.
This being an SBA loan, they don't want the money, they have to get it from the bank. Why do you need to go to the CDC?
Because that's, the SBA doesn't lend money directly anymore to anyone. The bank does the first half of the loan. The CDC acts as that intermediary that approves the loan, closes the loan. They hand it off once it's closed to, I believe, Credit Suisse First Boston, and that's who does that whole debenture picture. And you make your payment to Colson Services. Colson is the payment recipient for several government loans, all SBA loans, SBA 504 loans, VA loans. Colson Services has been around for a long time, and they act as that intermediary. But the bank doesn't handle this piece of it. Again, the same rules apply as far as what is considered single-use special purpose and startup. It's additional money down. Car wash would be another single-use special purpose because a car wash can only be a car wash. And probably should be considered an equipment loan more than a real estate loan because the majority of your financing goes to the equipment, not the shell. But they call it real estate. There's another SBA loan that is administered through conventional lenders, banks. The SBA 7A guarantee loan. It's up to $2 million, and what makes this different is that it's not a participation loan. The bank lends all of the money. The other good thing about the 7A guarantee loan is that you can use it for any purpose. It doesn't have to be equipment or real estate. It can be working capital. It can be inventory. It can be payroll. So the use is great. Pretty much any legal purpose. Now, it doesn't have a fixed rate. Rate's determined by the lender. Terms determined by what you're financing. So equipment, shorter term, real estate, you can go up to 25 years. And you could also include everything under one loan. So this 7A loan can include the working capital for your business. It can include the real estate. Now, if they do that, they're going to have to do a blended term. So it's not going to be 25 years over the entire amount. It's going to be a shorter term. And you want it to be a shorter term because the last thing you want to do is finance something for longer than the life of what you're financing. Again, the computer analogy. You don't want to finance a computer for several years because you'll replace it several times in that time frame. Typically, you're going to have a 10% down with this program too. It may go up, depends on the lender. Now, one thing that always comes up on 7A loans, people hear guarantee. It's guaranteed 75%. How can I lose? There should be a line at every lender getting these guaranteed loans. Lender can't lose money. And why do I need to collateralize my loan at 100% if you're getting a 75% guarantee? Doesn't make sense. You're killing me. The reason is, it's not the loan that is guaranteed. It is the loss that is guaranteed. The difference is, the SBA requires every lender to collateralize their loan as they normally would. And every lender is going to require 100% collateral coverage. And that's not just the lender being mean and evil. They get audited. And you have to have a secondary source of repayment. You have to. And if you don't, you better have a very good reason why you don't. And the SBA also doesn't want financial institutions to use this program as a method of doing bad loans. If they go bad, just get a guarantee and we're all happy. So you get the loan, do the loan as you normally would if you're a lender. Collateralize at 100%, make sure the credit scores are in line, do all of your due diligence that you normally would. And if it goes bad, and good loans do go bad, there's no lender that does bad loans, but good loans turn bad, like milk. If that happens, and you exercise all means to get repaid, so you liquidate the collateral, you go after any personal guarantees, everything you normally would, and if there's still a shortfall, let's say you lent the company $1 million, after all the collateral you got back $800,000. That $200,000 gap, you take that to the SBA and they give you a check for 75% of that. So that's much different than a 75% guarantee on the loan. Understand the difference? This last one, this comes into play for a lot of the smaller businesses and startup businesses. It's difficult to do a startup loan. And ECDI does startup loans. ECDI does startup restaurant loans, which scares the heck out of most bankers, because restaurant loans in general are risky because there's no real rhyme or reason at their success rate, and they fail at an alarming rate. Microloans are considered loans of $100,000 or less. Now, we do lend up to $100,000, but it's never happened actually. Never. Our average loan is about $30,000. Microloans can be used for anything except real estate and leasehold improvements, so nothing related to real estate. Only equipment, inventory, working capital, payroll, those needs. That's what most small businesses need, especially young small businesses. Usually don't get a startup business that wants a loan to buy a building. Now, rates on this program, your blended rate ends up being about 9.5%. The reason there is no concrete rate is because I currently have 17 different funding sources. That's City of Columbus, Franklin County, SBA, 4 different branches of the federal government, 4 banks. Why that's good, it allows us to leverage those funds and do more loans. So instead of having one pool of $1 million, I have several pools of over $2 million. Public sector money is typically a cheaper rate. State of Columbus, Franklin County, State of Ohio, typically cheaper. Private sector money, so the money that banks lend us, is typically on the higher end of the scale. And most of our money is a loan to us. We do have a few grants that there's no cost, but most of our money is a loan to us, so we turn around and lend that money back out. Now, how I determine, in most of our loans, that $30,000 average loan will probably have 4 different funding sources. How I determine the funding source when we're putting that package together, obviously if I want to use City of Columbus money, the business has to be located in the city. If I want to use Franklin County money, it can be in the county just outside of the city. State money, anywhere in our footprint. SBA money, anywhere in our footprint. Banks don't care, just give them a good return. I blend those funds together to give you a loan. Now, one thing, very important thing that I skipped over. With public sector money, there is a job creation component. I believe I left that out. So, city money, county money, state money, SBA. You have to create a job with that money. And it is anywhere between 1 job per $15,000 and 1 job per $30,000, depending on the funding source. City is 15, yeah.
Was that for all the different loans you talked
Yes.
about?
So city money, 15. SBA, I believe it's still at 30,000. It used to be higher. One of the reasons, how do I say this in a politically correct manner? It looks good to a politician that can say that my area created X amount of jobs through the help of this program. So all of our funders require reporting. Doesn't have to do reports constantly with 17 different funding sources. The main question they want to know is how many jobs are created. That's a big deal. It's a big deal on the news. Job creation, yes.
For a microloan, is that first job your job or
It can
is
be.
that somebody else's?
No, it can be your job. Most of the time in a startup, those first 1 or 2 jobs are the entrepreneur themselves and the partner.
On the 504, is it the portion they're participating in is the SBA?
Yes,
The
not over the
40%
whole
not
loan.
in the entire loan, but their portion?
Exactly right.
Okay.
Just on the public sector money.
Okay, and that is a 31 per 30,000?
Yes.
Is there a prepayment penalty associated with microloans?
No. No. I encourage you to play it paid off. Okay, some of these questions will be addressed later in the panel. I'm going to turn it back over to Mike. Thank you very much.
Just as a quick FYI, that presentation is already posted on the resource tab of SBDC Columbus. Right. So it's up there. You can go in, pull this down, have that information. We're going to try to post some links of some of those entities like ECDI, CCDC, all the kind of alphabet soup type of stuff we're going to try to post there. One last program we wanted to kind of give a little bit of an overview to is the state's capital access program. So we're going to have Jason Wells of the Huntington speak real quickly on the capital access program. Then we'll take a quick break. We'll reset for the bank panel, and then we'll move forward. Okay.
Good morning. I'm Jason Wells, and I work with Huntington and our enhanced lending programs. And I am centrally the bank's advocate for government enhanced lending programs, which aid in the efforts of making sure that small businesses get the money that they deserve through those programs. So a lot of my time is spent acting as a liaison at and with organizations like the SBDC and working with our underwriters and so our sales force so that they have as much education as possible about those programs. Mike asked me to speak a little bit about the Capital Access Program, which will be started with the Ohio Department of Development and begin with our state, and December 19th is the target date. You can go on the Ohio State Department of Development's website. It will be a feature program in 2012, and the theme obviously will be job creation and job retention. So in terms of looking for that type of financing, the loan amounts will range with working capital, lines of credit up to $250,000. Fixed asset financing, which is term debt, money for buildings, equipment, and so forth. That will go up to $350,000. So one of the things that you will have to commit to within those programs is obviously job creation and retention. And what the state wants you to do is to be able to, as a small business, is to be able to commit to at least retaining or creating one job over a 3-year period. What they want the bank to do is they want the bank to contain a reserve account, and Huntington has participated in this program over the past year and a half that I've been there. Within that reserve account, we obtain a fee from the customer. We participate in a portion, and the state participates in a portion. And this is an account for all the loans that we do through this program. And what it does is it's essentially there in the event that there is a loss of any of those loans that we use this program for. We can tap into that reserve fund to recover on the risk of it. I will be on the panel along with Randy, and if there's any particular questions, I want to make sure that I keep things moving along here. Because I know we're pressed for time. Please don't hesitate to ask me about it. Also, I'm at jason.wells@huntington.com. You can feel free to shoot me an email. I'd be glad to provide you with any information that you may need or direct you towards someone to the state. And also, another feature program for 2012, I just want to mention the name of it very quickly, but you'll begin to see information about it, is the Ohio Collateral Enhancement Program. And what the state of Ohio is going to do is they're going to put up a CD with the banks to offset your collateral shortfall, particularly in situations where you might have real estate deficiency in terms of your collateral, or you just don't have the down payment that you need to be able to purchase equipment and so forth. So with that, in a nutshell, gives you a little bit of background. I look forward to answering any questions later. Thanks, Mike.
Okay, so what we're going to do, we're going to take about a 10-15 minute break. There is some refreshments there. Restrooms are out here. For those of you that are sitting in some of the chairs, there are chairs at tables. You just got to kind of work in here. And then we'll move forward with the bank panel. So it's about 10-15 minutes and we'll reset and we'll see you right back.